Welcome to this channel, your gateway into the world's largest financial market, Forex. Here, we uncover the origins, the institutions, and the strategies that shape global trading. Bookmark tab's complete table of contents. Part 1: Foundations of the Forex Market. Chapter 1: The Origin and Evolution of Foreign Exchange Markets. Barter Systems and Early Money. Gold Standard and Bretton Woods. Collapse of Fixed Exchange Rates. Birth of the Modern Floating FX System. Chapter 2: Structure of the Global Forex Market. Decentralized Market Architecture. Interbank Market. Dealers, brokers, ECNs. OTC versus Exchange-Traded Currencies. Chapter 3: Major Participants in Forex Markets. Central Banks. Commercial Banks. Hedge Funds and Institutional Investors. Writing Hand. Chapter 1. Start, full writing. Chapter 1: The Origin and Evolution of Foreign Exchange Markets. Foreign exchange markets are among the oldest financial mechanisms in human civilization, yet they're also among the most technologically advanced markets today. The fundamental purpose of foreign exchange has remained constant throughout history: the facilitation of trade and the transfer of value across political and economic borders. 1.1 Early forms of exchange. Before the existence of formal currencies, trade occurred through barter systems. However, barter was inefficient due to the double coincidence of wants problem. The emergence of commodity money, such as gold, silver, and other precious metals, marked the first step towards standardized exchange. As international trade expanded, money changers emerged in ancient civilizations such as Mesopotamia, Greece, and Rome. These early exchangers converted one form of metallic money into another, charging a spread, an early version of today's bid-ask differential. 1.2 The Gold Standard Era. The classical gold standard, 1870 to 1914, established fixed exchange rates by tying national currencies to a specific quantity of gold. Under this system, exchange rates were stable. Capital mobility increased. Monetary policy independence was limited. Academic research suggests that while the gold standard promoted long-term price stability, it also amplified economic shocks due to rigid monetary constraints. 1.3 Bretton Woods and Fixed Exchange Rates. Following World War II, the Bretton Woods Agreement, 1944, created a new global monetary order. Currencies were pegged to the US dollar, and the dollar was convertible into gold. Institutions such as the International Monetary Fund, IMF, were established to ensure stability and manage balance of payments crises. However, persistent U.S. deficits and global dollar shortages made the system unsustainable. In 1971, the U.S. suspended gold convertibility, effectively ending Bretton Woods. 1.4 The birth of modern floating exchange rates. Post-1973, major currencies shifted to floating exchange rate regimes. Exchange rates were now determined by market forces, supply and demand, rather than fixed pegs. This transition marked the true birth of the modern Forex market. Volatility increased. Speculation expanded. Central banks adopted indirect influence mechanisms. Academic literature widely agrees that floating exchange rates improved monetary policy independence, but introduced persistent exchange rate uncertainty. Chapter 2: Structure of the Global Forex Market. The foreign exchange, Forex, market is the largest and most liquid financial market in the world. Unlike stock or bond markets, it operates decentralized, without a centralized exchange, and trades occur globally 24 hours a day. Understanding the structure of this market is crucial for both researchers and practitioners seeking to analyze currency movements, market efficiency, and institutional behavior. 2.1 Decentralized Market Architecture. Unlike centralized markets, Forex is an over-the-counter (OTC) market, meaning trades are conducted directly between participants rather than through a formal exchange. Key characteristics include: no physical location. Transactions occur electronically via interbank networks and trading platforms. Global time zones. Trading begins in Sydney, moves to Tokyo, then London, and closes in New York, ensuring continuous liquidity. Market tiers. The market is hierarchical, consisting of interbank, institutional, and retail layers. 2.2 The interbank market. The interbank market is the backbone of global Forex. Major commercial banks, investment banks, and central banks trade directly among themselves, often quoting bid-ask spreads as narrow as 0.1 pip for major currencies. Academic studies show that this tier provides the bulk of liquidity, determines benchmark rates used by smaller participants, is dominated by a few global banks known as Tier 1 liquidity providers. Research from the Bank for International Settlements, BS 2022, indicates that approximately 70% of daily Forex volume flows through the top 20 banks. These institutions not only execute trades, but also influence short-term volatility through inventory management and proprietary trading. 2.3 Brokers and Electronic Communication Networks, ECNs. Beneath the interbank layer, brokers and ECNs connect smaller institutions and retail traders to the larger market. Key features. Brokers act as intermediaries, matching buyers and sellers. ECNs are electronic networks that allow direct peer-to-peer trading, reducing reliance on human dealers. These systems enhance transparency by displaying multiple bid and ask quotes. Empirical research, King and Rhyme, 2010, demonstrates that ECN adoption has significantly reduced transaction costs and tightened spreads, especially during periods of high volatility. 2.4 Retail Forex market. Retail traders constitute a small portion of the overall Forex market, 5–10% of total volume. Their influence is limited due to smaller trade sizes, higher transaction costs, limited access to interbank liquidity. However, the retail segment has grown substantially over the past 2 decades, largely due to online platforms and leverage availability. Academic studies, Chabot et al., 2014, show that while retail flows rarely move the market independently, they can amplify trends during speculative episodes, particularly in emerging market currencies. 2.5 Currency pairs and market composition. The Forex market is organized around currency pairs, with transactions always quoting one currency relative to another. Major pairs include US dollar to euro, US dollar to Japanese yen, and US dollar to pound sterling, accounting for approximately 80% of global turnover, BS 2022. Key points. Major pairs, most liquid, low spreads. Minor pairs, cross-currency trades, moderate liquidity. Exotic pairs involve emerging market currencies, higher volatility. The composition of market volume affects price discovery, volatility, and efficiency, as research shows that major pairs respond more rapidly to macroeconomic news than minor or exotic pairs. Evans and Lyons, 2002. 2.6 Market segmentation and trading hours. Forex operates 24 hours a day, segmented into major trading sessions: Asia-Pacific session, Sydney and Tokyo; European session, London, Frankfurt; North American session, New York. These sessions overlap, creating periods of peak liquidity, especially during the London-New York overlap, which accounts for the highest trade volumes globally. 2.7 Institutional hierarchy and influence. The Forex market is hierarchical, with central banks and Tier 1 institutions holding the greatest influence. Central banks intervene to stabilize currency or achieve monetary policy goals. Their trades often signal market expectations. Tier 1 banks execute large volumes, provide quotes, and act as liquidity providers. Tier 2 and Tier 3 participants include hedge funds, corporations, and retail platforms, relying on Tier 1 liquidity for execution. Empirical research indicates that central bank interventions in major currencies, USD, Euro, JPY, can reduce short-term volatility, but may also introduce longer-term trend formation. Dominguez and Frankel, 1993. 2.8 Key takeaways from market structure research. Decentralization increases global access, but reduces transparency compared to exchange-traded markets. Liquidity hierarchy determines pricing efficiency and transaction costs. Institutional dominance means that market movements are often driven by a few large players rather than distributed retail participation. Session overlaps create predictable volatility windows, which are empirically measurable. References: academic sources, BS 2022. Triennial Central Bank Survey of Foreign Exchange and OTC Derivatives Markets. Bank for International Settlements. Chabot, A. et al., 2014. Rise of Retail Forex Trading and Market Implications. Journal of International Money and Finance, 42, 1-24. Dominguez, K., and Frankel, J., 1993. Does Foreign Exchange Intervention Work? NBR Working Paper. Evans, M., and Lyons, R., 2002. Order Flow and Exchange Rate Dynamics. Journal of Political Economy, 110, 1, 170-180. King, M., and Rime, D., 2010. The Market Microstructure of Foreign Exchange. BS Quarterly Review. Chapter 3. Major participants in Forex markets. The Forex market is a highly structured ecosystem where different participants operate with distinct objectives, capacities, and influence levels. Understanding the composition of market participants is crucial for analyzing market dynamics, liquidity, and volatility. This chapter synthesizes research on institutional and retail roles in the global currency markets. 3.1 Central banks. Central banks are the most influential actors in the Forex market. Their primary objectives include monetary policy implementation, adjusting interest rates to manage inflation and economic growth. Currency stabilization, intervening to prevent excessive volatility. Reserves management, buying and selling foreign currencies to maintain adequate reserves. Key research findings. Dominguez and Frankel, 1993, showed that central bank interventions have short-term effects on exchange rates, but often do not alter long-term trends. BS 2022 data indicates that central banks account for roughly 10 to 15% of daily market turnover in intervention-heavy currencies like USD, Euro, and JPY. Interventions are more effective when coordinated internationally, e.g., G7 coordinated actions to stabilize the yen in the 1990s. Central banks also influence market expectations through announcements, signaling policies before actual trades occur. This forward guidance can impact exchange rates even without direct intervention. 3.2 Commercial and Investment Banks. Commercial banks are primary liquidity providers in the Forex market. Tier 1 banks, e.g., JP Morgan, Citi, UBS, dominate interbank trading. They facilitate large-scale trades for clients and hedge their own exposures. Research highlights. According to King and Rime, 2010, top-tier banks execute over 70% of global Forex volume. Dealer inventory models indicate that banks adjust quotes based on their risk exposure and expected order flow, influencing short-term volatility. Banks also create forward contracts, swaps, and derivatives, further linking Forex with broader financial markets. Investment banks often engage in proprietary trading, using quantitative models to predict short-term currency movements. 3.3 Hedge funds and institutional investors. Hedge funds, pension funds, and sovereign wealth funds are speculative and strategic players. Hedge funds often trade with leverage, exploiting small inefficiencies in currency markets. Research, Chabot et al., 2014, shows that hedge fund flows can amplify trends, especially in emerging market currencies. Portfolio rebalancing by institutional investors can generate temporary price pressures, impacting minor and exotic currency pairs disproportionately. Empirical studies indicate that institutional traders' behavior is informed by macroeconomic models, statistical arbitrage, and order flow analysis, rather than pure technical speculation. 3.4 Corporations and trade-driven FX flows. Corporations engage in Forex primarily for operational needs, not speculation. Multinational corporations, MNCs, conduct cross-border trade, requiring currency conversion. Research shows that corporate hedging practices, using forwards and options, help reduce earnings volatility due to exchange rate fluctuations. According to Oon and Resnick, 2012, corporate FX activity accounts for approximately 15 to 20% of global daily turnover, concentrated in major pairs like US dollar to euro, US dollar to Japanese yen, and US dollar to pounds sterling. Trade flows are predictable, often following invoicing patterns and seasonal cycles, which contrasts with speculative flows that are more volatile. 3.5 Retail traders. Retail participation has grown significantly due to online trading platforms and leverage availability. Retail trading volume is estimated at 5 to 10% of total Forex turnover, relatively small, but sometimes influential in emerging market currencies. Academic studies. Chabot et al., 2014, King and Rime, 2010, show that retail traders tend to follow trend-based or momentum strategies, which may exacerbate short-term volatility but rarely drive large-scale market movements. Platforms like MetaTrader and ECNs have democratized market access, allowing retail traders to participate in a previously institution-dominated market. Retail traders are generally less informed than institutional players, relying on technical signals or macroeconomic news, highlighting the asymmetry of information in Forex markets.